Hi, welcome. Today we're going to be looking at the banking industry and begin our unit on financial institutions by looking at various financial options and getting a sense for what each of these financial institutions has to offer customers. So the goal is to be able to understand what is a financial institution and identify different types of financial institutions, as well as provide some benefits or risks to the various institutions that we identify. So we begin first by talking about what is a financial institution, and it's simply an organization that provides financial services to clients or members. By financial services, we're talking about taking deposits. So if you have money that you want to place in the financial institution where it's protected by insurance, for example, we're talking about an organization that serves as a go-between between those who want to borrow money and those who have money to lend. So that's what we mean by intermediary between lenders and borrowers. The financial institution is a place in which people who want to make loans can be put into contact with those who want to take out a loan, and they can conduct business together. There are lots of different options out there for financial institutions. There are banks and credit unions, which are the two most common and the two sort of preferred ways of doing most of our banking. There are insurance companies, payday loan companies, and check cashing companies, and those last two are pretty horrendous. And so we're going to take a look at those in just a second. When it comes to financial institutions, it's important to understand that not everyone is equal, that the costs of doing your financial services work at places like payday loan companies or check cashing companies are extraordinarily high, and so under virtually every circumstance you should stay as far away from these groups as possible. And we're going to talk about why here in just a second. First off, what is a payday loan company? Well, a payday loan company is a company that you can go to when you need a short-term loan and a small dollar loan. Most banks aren't going to give you a loan for $100 or $200, and yet sometimes people find themselves in a financial situation in which they need to pay their rent at the end of the month, and they're a couple $100s short, and they need to find that money somewhere or risk being evicted or kicked out of their home. So places like a payday loan company fill in that space and offer people small loans for a 14-day or 30-day period. And so they're going to argue that they're meeting an important financial need in the marketplace. But it comes at a cost, and that cost is extraordinarily high interest rates, sometimes bordering on over 1,000% annual interest rate. And that's why most financial advisors would encourage you to stay as far away from payday loan companies as possible. Some data about payday loan companies includes that the average loan, at least a few years ago, was about $375. And that it took people, on average, about 6 consecutive payday loans, that is 6 loans each month, 1 loan each month for 6 months, in order to pay off that $375 initial borrowing. In fact, 80% of payday loans require another payday loan to pay them off. That's one of the most important rules of personal finance, is that you should never take out a loan to pay off another loan, and yet that's what you do with payday lenders. At the end, most people find that the costs that they pay in terms of interest and fees was actually more than the actual amount that they borrowed. And so we look at a real-world example. We look at advanceamerica.net, which at the time of this recording had a location at the end of Fairfax Circle. And we can see that on their website, if you type in what would it cost for a $500 loan, which is the maximum you're allowed to take out for them, on a 14-day basis, that $500 loan will cost you $612. $500 in the loan, $112 for finance charges and interest payments, which brings us to an annual percentage rate of nearly 600%. And then if you were to take out the loan for 30 days and not 14, still $500. Still going to cost you a significant amount. It's going to cost you $620 when you're done with finance charges, but the annual interest rate is slightly lower. It is nearly 300%, which is significantly higher than any commercial or traditional bank or credit union would charge you for a loan. Check cashing companies are similar. When people do not have bank accounts, they cannot cash checks for free. You cannot receive a check from somebody, go to any bank you want, and have them give you cash in exchange. You have to be a member or a customer in order to do that. Some people do not have checking accounts, and so the only way for them to get their checks cashed is to go to a check cashing company, which they will do for you, but only after you have to pay them a significant fee in order to get them to give you cash. This option is helpful if you have no other options, I suppose. But this is why when we talk about banks and credit unions, it's important for you to figure out which of these two options is best for you and begin to establish an account with them in order to avoid having to use a place like a check cashing company in order to get cash. When it comes to more reputable forms of financial institutions, banks are one of the leading ones that most people in America will use. They are companies, they are corporations whose job is to offer checking accounts, savings accounts, and loans to their customers. And with those different types of accounts are a wide variety of services that you can take advantage of. So most banks will offer you access to debit cards, which is giving you an electronic access to your checking account. They give you credit cards or make it available to you. Personal loans, car loans, mutual funds, which are a form of investment, which we'll deal with later in the course. They have safety deposit boxes where you can leave things locked up and protected. And so there's many different services, financial services that you can receive by being a bank customer. All of this comes with fees, I suppose, in terms of interest rates when you borrow money, but these interest rates and fees are significantly lower than what you would get at a check cashing or title company or a payday loan company. And there are a number of banks all across America, not only major banks that you've seen commercials for, Citigroup or Wells Fargo, but then also local banks within various communities. Credit unions are another type of financial institution that you may look at. Unlike banks, they are not private corporations. They are in fact cooperatives. They are associations. They tend to have lower interest rates and better services and lower fees because you're not a customer of the credit union. You are a member of the credit union. You're an actual part owner of the credit union. When you put deposits into the credit union, you have a stake now in the success of the organization. And so you actually will oftentimes receive payment as in the form of dividends. That is, if they have a profit, they may give back some of that profit to their owners based on the amount of deposits you have at the credit union, or they may pay out dividends in the form of lower fees and interest rates to their members. In order to become a member of the credit union, typically you have to meet some sort of membership requirement, whether it's being a teacher for Apple Federal Credit Union or being a member of the military for Navy Federal Credit Union, whatever it is. They limit who can be a member of their organization, but those who are members of the organization are treated better than regular customers at a bank are, at least typically. And yet they still offer the same kind of financial services that you might get at a bank. You still can have access to loans and credit cards and debit cards and all of the things you have at a traditional bank, you also receive at a credit union. One final option is what we call a savings and loan. These organizations are very similar to banks in that they receive deposits from customers, and those deposits are used to pay interest to depositors, and more importantly, those deposits are used to make loans to home buyers. So the purpose of a savings and loan primarily is to make home loans to people. They're less prevalent than they used to be, but that's their main function. You are to put those who are members will put money in these savings and loans with the expectation of higher rates of interest, while those organizations then make home mortgage loans to people who are looking to buy a house. They don't make business loans or anything like that. They are strictly home loan based. So that's another option. It's a little less liquid because they don't have the same kind of financial services that a traditional bank does. But if you're looking for higher rates of interest, then a savings and loan might be a better choice for you. We'll look more into the different options between banks and credit unions and begin to make some decisions about what makes sense for us in class, and I will see you then.